walk over me. Here you go again, always me. All the things you say, none of it comes true. Met with a guy in LA. Good for you, it's all about you.
Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is inflation day. That's right. CPI out this morning. All eyes on the inflation data as we get ready to see what happens next. And look, a cooler than expected inflation print this morning. Big surge in the markets. Hotter, big decline. So it's a binary outcome, however we come about this. So this will be something that we'll talk more about tomorrow about the actual inflation number. We'll dig into it tomorrow with Michael Leibowitz, but that's going to be the big driver this morning. Right now, futures are kind of flattish a little bit. S&P's up about 5 points. Nasdaq's up about 12 right now. So, but we'll see. Yesterday futures were a lot higher in the morning. We sold off sharply during the day, came back to close about break even yesterday. So, but we'll get into all that in a minute when we get into before the bell. Of course, we talked about yesterday, the big eclipse on Monday, and it's amazing what you learn, right? And the stuff that you can, I just never knew, right? Sheila Jackson-Lee yesterday addressing the media, doing a speech saying that, be sure and get out and see the full moon because it's mostly made of gases. I didn't know that. I thought it was made of cheese personally, but apparently the moon is made of gases, and it's very hard, to fly to the sun. So it's easier to get, the sun's too hot.
Right.
Right.
Yeah.
So she says it's easier to get to the moon, even though it's mostly gases. These are the people running our country, folks. I mean,
who knew?
Who knew? Learn something new every day. Anyway, just because you hear it on TikTok does not mean it's true, right? So
she could have been mayor.
She could have been mayor. She almost did it.
Yeah.
She was almost mayor. Is she still? So she's still in Congress?
Yeah.
Okay. So she didn't give up her seat for that?
No.
Okay. She would have if she would have won.
She was going for like another job while she's in her other job.
Gotcha.
Yeah.
That works out well.
Makes me feel good.
Just kind of work a side gig, Mayor of Houston, right?
Congress is a side gig.
All right. Anyway, a couple of things to get into this morning. Of course, yes, the inflation data. We'll get into that here in just a second. We'll talk more about that. Also, the NFIB report out. I touched on this right at the close of the show yesterday. The National Federation of Independent Business. This is the survey of small businesses around the country. Incredibly important data because 50% of the economy is driven by small businesses. And look, the vast majority of small businesses have 5 or fewer employees. So, you think about all the businesses around your house as an example, right? They don't have a lot of employees. Those are small businesses. They contribute to the economy. And small businesses, despite the fact we talk about Apple and Google and, they're laying off people, et cetera, we focus on those because there's the big, massive companies. And when they have a layoff, right, they lay off, 5 or 10,000 people at a whack. So that's important. But 50% of small businesses drive 50% of the employment in the economy, but we don't hear about when they lay off a couple of workers here or a couple of workers there because it's too small, but that is going on. In fact, the sentiment index for the National Federation of Independent Business yesterday fell to the lowest level in 11 years. So despite this idea that we're having this booming employment, etc., they're very dour about the economy. And importantly, their hiring intentions have dropped sharply. And for the first time that we've seen here in a while, one of their biggest concerns, poor sales. So again, this is kind of really an important point, because when they start seeing poor sales, right, that crimps a lot of what they do. In other words, they don't order as much inventory, they don't hire workers, etc. And we're seeing a very sharp uptick now in poor sales, which typically has a fairly high correlation to actual retail sales. So again, as we kind of just look forward, there's a big dichotomy going on between what's happening in the headline economic data. Yes, we have strong employment. We've got very strong manufacturing data here as of late, etc. All looks good from the economic surface, right? But once you dig underneath this, well, not so much. And again, this is one of those things that we keep kind of paying attention to, because we still have a lot of indicators out there suggesting the economy is far weaker than headlines suggest. Inverted yield curves, leading economic indicators, all that suggests much weaker economic growth than what's being reported. Again, right now, the Atlanta Fed's expecting 2.5% growth in the first quarter of this year. Now, that's coming off of near 4% last quarter and nearly 5% quarter before that. So we've had very, very strong economic expansion over the last 3 quarters, but the data doesn't really support it. So, kind of what gives. And that's what we've got to kind of figure out. Okay, but let's talk about inflation here, because this is what's going to drive the markets. Here's what you need to know before the bell this morning. The market yesterday, we broke again below that 20-day moving average, but right at the end of the day, in the last 30, 45 minutes, the market had a fairly strong rally, got back above that 20-day moving average, so continuing to hang on to that level of support by fingertips at this moment. But the market's not ready to give up the ghost just yet on that support level that's been holding the market together really ever since November. This morning, of course, if we come in with a weaker than expected, right now the expectation is for about a 0.3% increase in inflation last month. Now, interesting, this story out this morning that the BLS actually released the inflation data early to some Wall Street banks. So there's a big scandal going on that the Wall Street banks knew about the hotter rate of inflation in January because of a change to how they calculate the rent, right? We talked about in January, had this hot inflation print because rent went up in price. It was due to a mathematical change. So again, are we actually measuring the data? Or are we just doing a lot of, manipulations to the data? We'll see. But anyway, kind of a big scandal going on right now because of this early release of data. But this morning, expectations are for 0.3. If we come in below 0.3, in other words, come into the 0.2 or a 0.1% print, we're going to see a very, very sharp increase. And in fact, we should be able, theoretically, to take out this level of tops that we have been putting in now for the last, several trading sessions. We've had this kind of top that we were building, and multiple tops there. Market kept bouncing off of that. We've been compressing that channel between that kind of top and the 20-day moving average, which has continued to rise. So again, a weaker print today should push us out of that range, put us back onto that trend that we've been in really kind of since November, this rising trend. We started kind of petering out here a bit, showing some signs of weakness, but a weak print should put us back on track. A hot print is going to break this 20-day moving average and start pushing us towards the 50. So again, this is going to be a binary outcome today in terms of inflation, so we're watching it closely. We'll talk about it more tomorrow with Michael Leibowitz. But the expectation for right now is kind of a inline print. Now, if we get something very close to inline, market may not do a whole lot today, because this is all going to really kind of register off whether or not the Fed is going to cut rates in June. A weaker than expected print of inflation suggests that the Fed will cut rates in June. A hotter print is going to push that rate cut expectation out further. Again, this whole market is hinged right now on whether or not the Fed is going to cut rates. That's all going to be determined most likely by this print this morning on CPI. So it's become very, very important to the overall market. So we'll be watching it. And again, we'll talk about this more tomorrow. We'll, of course, write about it in the morning in our daily market commentary. But again, for right now, nothing has really changed in the market at all. We continue to hold on to that support level. It's just kind of a waiting game to see. So anyway, keeping that up. That's what you need to know before the bell this morning. When we come back, we're going to pick up with Danny Ratliff, talk about how to save Social Security That's going to be part of today's topics as well as others. Don't go away. We'll be right back. More coming up with The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Of course, Danny Ratliff joining me this morning. Danny, how are you?
Hey, great. How are you, Lance?
Good. So a couple of things, as I was saying, inflation's out this morning. All eyes are on that data this morning, and not a lot else going on. It's going to be pretty quiet outside. We do have a couple of Fed speeches today as well. Also, the release of the FOMC minutes from the last meeting will come out today, so we'll also get kind of a hint of whether or not the Fed is leaning towards cutting rates or not. That's the whole market just hinges on what's the Fed's going to do. We don't worry about earnings. Valuations don't matter, earnings don't matter. It's all about what the Fed's going to do, right? So the Fed's going to cut rates, they're not going to cut rates. That's all that matters. So that's where we are. So that's why when we look at this, FOMC minutes will dictate a lot of that today.
Yeah, it looks like Bank of England, ECB, they've all kind of changed courses a little bit. Maybe they're saying that ECB and Bank of England may be first to actually cut
rates.
Yeah, so that'll be interesting. And then, how much of a correlation though do we need to watch as far as CPI and PCE? Because I think the Fed seems to have their big target on PCE, but it seems to be like the redheaded stepchild compared to CPI, right? Everybody's following CPI, but the Fed has clearly mentioned that PCE is what's the big driver.
The Fed uses the trimmed mean PCE, right? So you can actually look that up. If you go to Fred, the data source from the Federal Reserve Bank, it's just type in Fred in your Google search. You can search all of these topics on their website, and it gives you all the data, right, with charts and everything. So, but what they use is the trimmed mean PCE. That's really their key driver for whether or not they're cutting rates and all that. And so PCE is personal consumption expenditures. So they're looking at the inflation, the mean inflation for consumer spending. Really, that's what they're looking at more than anything else. So CPI really doesn't factor into that decision. They certainly pay it. Now, don't get me wrong. They're certainly paying attention to it, right? But PCE is really the number they look at. And there's fairly decent correlation between the two. So,
well, now with that NFIB survey, we would think that we would see all these decline a bit, right?
Well, you would think so.
Yeah.
Right? But again, there was an article out this morning, unfortunately, talking about how the government source for that data has been releasing it early to Wall Street banks. So, and of course, this is why every quarter, if you take a look at Wall Street banks, their trading desk have absolutely perfect trading desk.
Yeah.
Every quarter, like 100% of their days are positive. Regardless of what the market's doing, they make money every single day.
So do you mean somebody's being bribed, Lance?
No, not bribed at all. Just they get, if you're a major bank, right, and you're a member of the Fed, maybe you get some preferential treatment. They're called super users, to
But wouldn't that be insider trading for you and I?
No, it's not. No, it's this is they're not trading
not
on
specific to a company, but
correct, right?
But,
They're just getting access to data that, before anybody else. So you have a small advantage.
Small. Yeah. Okay.
Small advantage. Anyway,
just a little bit.
But it's just none of this should be surprising, right? That any of this goes on ever, right? This isn't the first time that the government's got caught releasing data early, and then they said that typically the excuse is, oh, it was embargoed, it just went out on early. Oops, it was an accident. So
always something.
Yeah. Anyway, all right. So the kind of a couple of things, we're getting ready to move into the summer months. We're getting ready to go pre-election. There's a lot of expectation that, this market's going to just kind of continue to rise from here. We are starting to see some kind of cracks, as we talked about technically in the markets. The momentum has been slowing down as of late. So kind of the question is, Danny, is if we get ready to kind of move into, later spring, summer months, which typically tend to be weaker months of the year anyway. If you remember last year during the summer, we had about a 10% correction. Not bad. I mean, completely normal. Shouldn't worry about it. But, is there anything that investors need to be doing right now heading into kind of the spring, summer period, kind of from a financial planner standpoint?
Yeah, I think this is an interesting time. Obviously, right now, I think most people are just, scrambling to finish up taxes as we, head to the 15th next Monday. But from a portfolio perspective, you and John touched on this a little bit yesterday. Just the optimism in general of the market seems to be that, we continue to bounce off that 20-day moving average. At some point, their average is for a reason. We're going to see this pullback. And what I would really caution against is making knee-jerk reactions. I think that because we have continuously over the last several months seen the indexes rise. Now, granted, that doesn't mean that everybody's seen that in all of their portfolios because, if you're not just in that index, you may not be participating like the full index is. So, I also caution on that to understand exactly how you're invested and what you should benchmark towards, which is why we create hurdle rates and look at not just one benchmark, but many, and create more of a customizable benchmark to understand, what we're actually and how we're investing. But, if we're going to see that potential drawback, I don't know, Lance. I mean, we're proponents of being a little more active and taking, drawing down a little bit of risk. So we're a little bit underweight equities at the moment. Likely will be, again. So I think our conversation as of recent has been that, all right, we bounce off the 20, we close it above that, this Friday. We'll likely, at some point, if we get another little bit of more momentum, reduce exposure. Not take everything off the table by any means, but just a little bit. And then from there, look for opportunity if we do get that bigger drawdown. And I think that's the most difficult part for people, right? It's the timing of it. It's the, you see where you've had some gains. A lot of people have a difficult time taking those gains and paying taxes on it. And that's really difficult long term, because what happens is now you have this huge tax gain over a longer period of time, and it's difficult to offset many times. And so we see a lot of people who just say, hey, we let that tax tail wag the investment dog. And they're like, well, heck, I'm not selling this. Well, great. You could have paid, 15% long-term capital gains, but instead you've just lost 45% of your position. Which would you rather have? So, we've got to be cautious with that. But I think that, heading into this, I think just keeping a level head, understanding that we should expect volatility. We typically do see that 10% pullback, every year or so, not uncommon. And, kind of sticking to your thesis, understanding what your discipline is. And that's, I think, what most people operate without a plan or without some type of discipline to, shore up equity markets, understand exactly what you're doing, protect against losses, take some of the profits as we move forward. But, you talk about this each and every day in a lot more granular detail. But I think that's kind of just at a really high 30,000 foot level.
Right. And again, I think the biggest point is that, people do get too tied up into what's happening with the, worrying about taxes and taking gains, those type of things, because, once you kind of see that, the reality is that, we don't actually, we worry about taking gains because we're worried about when we're going to miss out on the market, right? And we're worrying about, if I sell now, what's going to happen. But, this is because we typically, think about taking gains as I'm selling the whole position and not just taking some of the gains off, right?
Yep.
And it's kind of this all or none attitude that, investors tend to make the mistake on the most, which is, if I'm going to sell it, I'm going to sell the whole thing, right? And that's just, and then the other side of that is that they sell it, and then for some reason they magically believe that there's some rule that says you can't buy it back.
Or especially if you sell at a loss. I mean, I feel like if you sell something at a loss, people are like, I am never touching that position.
Exactly.
I hate that company.
Now, you can't. Now, if you sell something at a loss, don't buy it back for 30 days.
Yeah.
Right. There is a law against that. Right. It's it's tax loss for selling. But yeah, there's this attitude like, I sold it at a loss, so I'm never going to buy that stock back again. No, it just means if you sold it at a loss, you just bought it wrong. Doesn't mean that unless it's a bad company, then you don't want to buy it back. But if it's a good company and you just bought it at the wrong time, sold it at the wrong time, doesn't mean that once it kind of settles down, gives you a good entry point, that you can buy it back. It's just the psychology of investing is always the most fascinating thing to me.
It is. I mean, that's a big part of it, the emotional side of it. And there's companies that we own that we really like that have not performed like we think they should. But if you look at them, they're growing earnings each and every year. They look like a very fundamentally sound company, or they are. But the stock price just isn't doing what we'd expect it to do. And so that's something that you may say, hey, we'll hold on to it. Or we get out and we come back to it and revisit it at another point. But, the emotional side of that, Lance, is huge. I've seen many people here recently who've been much more conservative in nature say, you know what, maybe it's time to start to, take the guardrails off a little bit because my feelings are getting in the way of overall what the actual markets are doing.
Right.
And that's, I thought, well, this is actually pretty mature in a lot of ways to think about this, right? And these are astute people, very smart, but said, I think it should do one thing, but clearly that's not what's happening. And clearly these things don't matter right now. And so I need to just let you guys kind of manage funds and step aside, which is great. We like that aspect. But, these are your funds as well, so you need to be comfortable. But we do find, how many times do you find that somebody's just, this person's going to be elected, here's exactly what's going to happen. I'm not doing anything. We're gonna stay out. We want to go straight to fixed income, or vice versa.
Yeah.
You see that a lot.
Yeah, again, but that's that psychological kind of emotional, biases that we get tied up into that we, and then we don't change, right? So we get tied up into this, we make a decision, and then we don't want to admit that we were wrong, so we just hang with it, right? And so it's like we fight ourselves the whole way, and we just compound bad decisions with other bad decisions on top of it because of our emotional biases.
How many people have you seen, Lance, that have shorts? They're like
inverse
related ETF. Ha ha ha.
My wife says they'll have
ETFs.
holes in them, but yeah, I have shorts.
Yeah. So those inverse related ETFs that they've held for years, and I'm talking down, some of them down, hundreds of thousands of dollars. Like, I'm not selling. It's going to happen one of these days.
One of these days, that crash is coming. And they're right, and they're going to be right eventually, right?
But has it gone up so much along the way that you'll
never get back to even at this point. So, yeah, but I just actually ran into that. Well, I was talking to a guy the other day, just same exact thing.
Yeah.
It's been short since 2010.
Wow.
Yeah.
Like all short?
Mostly.
Oh, man.
Mostly short. I think he did have some NVIDIA stock, but other than that,
well, hopefully he had enough.
So, all right. Quick break. We'll come back. Can we save Social Security? I wrote an article about Social Security here recently, and it always gets Danny fired up, so he found a way to save it. We'll see if he's right. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately, for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If you take a look at a lot of these videos that are getting put out on TikTok, it's like, working for the rest of my life, I'm just supposed to do this forever because I need money. The struggle is real for the new generation, which is now learning that 9 to 5 isn't as easy as going to college.
The Real Investment Show podcast. Same show, your schedule.
My daughter, she's 17, and she's discovered Kroger points for getting a discount on gas.
At realinvestmentadvice.com.
The struggle is real.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1935, President Roosevelt first enacted Social Security. The intention was to cover older workers as a safety net. So in other words, you're working, and then you just basically get too old to work. And back then, work was fairly brutal. Lots of, there wasn't a bunch of cushy office jobs back in the 30s and the 40s. It was a lot of very manual labor, manufacturing, dangerous work. And so, working into your much latter years was not an option. Your body just wouldn't hold up for it. And so so President Roosevelt came up with this idea of Social Security to provide the safety net for older workers. And you weren't supposed to live past the age of 60. That was the average life expectancy. So you retired, you lived for a few years, had a little bit of support from the government, and then you passed away and everything was fine. And back then we had 42 workers contributing to Social Security for every person that was taking out. Now, mind you, back then, it was a relatively new aspect, and people didn't live that long. You had a lot of workers, so it worked out great. Today, I have a chart on this. If you take a look at covered workers for Social Security, we have about 2 people paying in for every person taking out. And the reason for this is, several reasons. First is we've had a declining fertility rate for quite a long time It takes 27 years roughly to build a taxpayer. So as we have fewer and fewer children, that fertility rate becomes a problem on Social Security because it takes such a long time to actually build a taxpayer into the system. So that's one problem. The other problem is that this, as we've had declining fertility rates and fewer workers paying into the system, we've had an increase of beneficiaries taking out of the system. So back in the 60s, we added, widows and orphans, and over the years, every time that there's some kind of stranded group of individuals out there, and the government basically wants to get some votes, then they try to use Social Security as a way to give some money to a disenfranchised group of individuals. It says, oh, here's some money for you, vote for me, right? And so we've continued to add more and more people taking out. So we've got more people taking out, fewer people paying in, and it's a problem. Stark Realities wrote this, saying that the program's payouts have exceeded revenue since 2010, but the recent past is nowhere as grim as the future. According to the latest annual report by Social Security's trustees, the gap between promised benefits and future payroll tax revenue has reached a staggering $59.8 trillion. That number is now $174 trillion between Social Security and Medicaid. So there's your problem. It's a math problem. We've talked about this before. And we wrote an article about this recently. This same problem also applies to pensions. And the problem that is now hitting corporate pensions at a much faster rate than what was expected is really twofold. And that is the fact that retirees, all of a sudden, we've had, since the pandemic, we gave so much money to people, and there's so much money floating around the system because of all this government intervention, is that the number of retirees, I have a chart on this as well, has surged dramatically since 2020. And so here's your problem. It's an actuarial problem. This is math. And the way that pensions work, whether it's insurance, a pension program, Social Security, Medicare, Medicaid, doesn't matter. All of these are based on actuarial functions. And what these functions rely on is they say, okay, I have this group of people that are going to live this long. Here's my life expectancy. They're going to retire at these certain phases. If I've got this much coming in, I've got this many people retiring at some point, I can live this long. So two things happen that can mess all that up. One is that you don't get the rate of return. You have a big bear market, whatever it is, or you don't get enough people contributing to the program, so you don't have as much money as you thought you were going to have, or you have too many people retire too early or faster than what your schedule was, and all of a sudden your benefits won't last as long as you thought they were. It's just math, right? This is just how the actuarial tables work. So this is the problem. Danny's got he's going to fix it right now for you. Good, Danny, go.
No, I don't think we're going to fix it
right now. You came in. You said we're going to fix this. So,
well, here's the problem, right? And YouTube chat's been on fire this morning with talking just about this and a lot of other things. But this is a pill nobody wants to swallow. Right. It's difficult. So we continue to kick this down the road. And unfortunately, I don't have much faith and confidence that we're going to address this before, we have a fire drill. I mean, we've got a big problem. And so, currently, you mentioned it. Right now, pensions have a problem. Mm-hmm. Everybody has a problem. Pensions have a lot of problems, but one of their big problems is not just when people are retiring because they're retiring early, which is the same problem Social Security has. But the problem that we see is that if you want like a pension, there's proposals to say, let's invest Social Security funds.
Right.
Unless Nancy Pelosi's doing it, I don't want anybody messing with it, right? I mean.
Yeah, Nancy Pelosi should be head of our Social Security. I don't know how they're going to keep propping her up, but you put her ahead in charge of Social Security, let her trade away.
Yeah, exactly. But that's the problem, is that we've seen so many of these pensions have blown up because what have they done? They go and they interview all these investment fund managers and say, okay, this guy promised me 12%. Oh, this one's at 10, this one's at 8. This one over here is at 6. He may be more realistic, but we've got to go with the one that's going to give us the most return. Well, what they don't understand is how much more risk they took. And then you see these guys get belly, they go upside down. Now they've got bigger issues. Right. And that's a problem that scares me with trying to have government control something, especially that, they historically don't have a real good track record with.
Right.
And so I wouldn't want, and there's been proposals to say, let's go have these funds be invested. I wouldn't want that. I don't think that's the right solution. There's no solution that, right now we pay 6.2%, the employee and the employer, in Social Security taxes. all the way up to $168,600 for 2024. So you make more than that, you get a bit of a raise. This can be problematic as well, right? Because now, and what they're saying is that this actually makes it more fair for everyone.
Mm-hmm.
I don't know how that's the case, because if you're a high income earner, you're putting in typically much more than anybody else. But the amount that you're receiving, you may not feel like it. It's still a pretty good deal that you get on an annualized basis. In fact, you typically get millions of dollars back over your lifetime if you take Social Security properly.
Right, and live long enough.
Yeah, and that's properly live. Yeah, those two things have to go into together. So these are issues I think that that everybody's going to be challenged with. Is that, do you change that Social Security tax? Do you get away with that cap? That's been a big conversation that we've seen. That's one way you can potentially fix this. Another one, this has to do with swallowing that pill, and we've seen what other countries, i.e. France, has done when they tried to raise the retirement age. Raise the retirement age, the full retirement age, from 67 to say 68. There's been proposals to put that more in line with life expectancy. Could work in their favor now. It's gone down a little bit since COVID, but these are things that could be done. Now, here's the problem with this too, is that may be a moving target. What are they going to attach that to? Like, you look at Social Security inflation adjustments, right? So we get that COLA, cost of living adjustments, and that's done on an annualized basis, but it's not. It's on CPIW for workers, what their inflation typically is, not for CPIE, which is what we believe it should be done on, which is for the elderly, but which is going to more closely align with healthcare costs, pharmaceuticals, all the things that typically, as you're a senior, that you age, that you're going to utilize and need more of. So they could go and make these modifications, but they're probably a day late and a dollar short in a lot of ways, and it's going to be extremely difficult in that this is not electable. Nobody, I mean,
no.
I've seen people my age raising Cain about, online saying, they're going to go after our Social Security. This is our money. Well, okay.
It's not your money.
Social Security is the biggest Ponzi scheme that's out there,
look,
right? Because you're paying in for people right now.
Right.
Somebody pays in for you later.
Right.
You've got a demographic issue which you address, and it takes 27 years just to fix that problem.
Yeah. I haven't, this isn't on your list, but one easy rule to fix that would start helping is to lock off Social Security and Medicare. And what I mean by that is that you can no government official going forward can give benefits to any other new group of individuals. So we can't come, next year we can't come along and say, oh, we need to give benefits to disenfranchised, people, whatever. Pick a number, right? Whatever it is. Just no more. We can't add anybody else to the roll. And we need to take, if you're not a tax-paying worker, right? And this is where it's going to get a little dicey. But if you're not a tax-paying worker or the spouse of a tax-paying worker that's paying into the system, you can't get benefits from Social Security. So if you want to set up a fund for disabled individuals, great. Let's set up a new fund for them and figure out a way to fund it. But you've got to start separating this stuff out and not just this being the pool of ingestion where we just throw everybody into it that we want to give money to.
So no more newcomers?
Yeah. Well, I'm just saying, you just can't pick a new group of people and say, hey, we're going to start giving Social Security benefits to them. Right? You've got to stop at some point adding people to the pool that are taking money out but not paying in.
Well, I agree, and that's the problem that we've got into over the years. I mean, not to mention just the demographic, but we have opened it up to so many different groups that this was not intended for.
That's right, and that's what I'm saying. See, nobody ever addresses that. Let's raise the retirement age, right? Let's cut 401k benefits. Let's do all these other things, but we're not addressing the one problem, which is we keep adding more and more people to the roll.
Yeah.
Right.
Well, that is not on the list,
but
Lance.
that's not electable either, by the way.
Well, none of this stuff's electable, right? And because these are hard things that people, you have to have some self-responsibility in saving for your retirement and not relying on Social Security. And the numbers show that that's unfortunately not where many people are. Listen, I get it. There's a lot of people that are, most of America is living paycheck to paycheck. They're just trying to make ends meet.
Yeah.
So this is a great benefit, but when you dive into the numbers, it is absolutely scary how many people rely on Social Security for the majority of their retirement income.
I know.
Because they're unable to save.
How much is it on average?
62% rely on it for more than 50% of the retirement income. A quarter rely on it for more than 90%. That is big numbers.
Right. And as Richard says, if you try to take those benefits away, lots of people on the street.
Yep.
So it's an unfixable problem is what you're saying.
It's fixable, but it's not easy, and it's not electable.
There you go. All right, quick break. Come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So lots of discussion right now about, we've had just a ton of phone calls from clients, prospects, etc. As of late, talking about the Trump social media stock, symbol DJT. Of course, just recently, the SEC approved the merger between True Social and DWAC, which was the kind of the media company that was out there, the social media company. And so that merger created DJT, which has had a huge spike on the day of offering. In fact, I believe, I don't have the exact numbers, but former President Trump made about $4 billion on the day of the offering. When it came out, we had a lot of phone calls right after that saying, do we need to buy this stock, right? And as is usually the case, whenever these things occur, it's always best to kind of just sit back and wait and kind of watch what happens, because there's generally a big rush of things that occur all at once. You have a lot of people kind of chasing speculation, et cetera, and there was a huge spike in the stock. Now, since then, that stock has been kind of tailoring off here and is basically returned back to where it was pre-merger. So that whole spike has been reversed at this point. Now, again, if we take a look, kind of at a daily chart of this, and you can see this kind of huge spike that occurred. DWAC traded flat for a very long period of time. As news about the potential merger kind of formed, the stock started making some traction, and then when the actual merger happened, you see this really big spike on the far right hand side. Now, that's all been reversed up to this point. So again, but this is similar to what we see with all IPOs, and we saw a lot of this back during 2020 as we had this rush of IPOs to market of any these disruptor companies, and then when we couldn't get IPOs to market fast enough, we came up with SPACs, and we'd see these very big pops in these stocks. And just kind of the rule of thumb, as always, is never buy an IPO, right? That's just never buy an IPO right out of the gate, because most of the time, not always, there are certainly exceptions to every rule. But, you know, when it comes to investing, there's some rule of thumbs that kind of work more often than not. And as an investor, we're trying to maximize our probabilities versus possibilities. So it's always possible that an IPO can come out, then just go straight up to the moon. It's possible. Most likely, what probably happens most of the time, the probability is that you get that initial spike, it sells off, because the individuals that were long the stock to begin with when it was private and went public, they're selling to the public. So the insiders are getting out. You're buying at a big premium. And then the people that were selling you the stock at a big premium, they come in and short the new stock to catch it on the other side. And so that's why you generally see a decline out of the gate as that initial premium is worked back off. And that's what's happening here. So, you know, we were advising people, no, don't go buy DJT yet. You know, just wait. There's, you know, they've got a lot to prove whether or not they can compete with Twitter and other forms. And look, they have a very good footprint. They've got a very good base. It's very likely they're going to do well. But avoiding that initial spike has worked out well. And so now you're starting to get to a position where the stock's kind of starting to find a little bit of support. And this is why it's important to always wait after an IPO. Again, if you'll wait 6, 8, 12 months following an IPO, you can look back and look at technicals. Where was technical support? Where was technical resistance? And you get a much better idea of where the stock trades, so you can manage the risk of buying an IPO or a merger in this case a lot better. So, you know, that's just kind of the way to look at it. But again, this is one of those things. So, it's interesting because the headlines, there was a headline in the Market Watch this morning. Trump social media stock, of course, they hate President Trump, right? So anything they can find that's not good for him, they're going to print this. Trump social media stock, DJT, is having a bad April as it heads for a fifth straight drop. Yeah, not surprising. Again, you had that initial pop. It's going to pull back. Now, the question is where does it find support, and where do investors start buying this stock and it starts finding its kind of levels where it's going to trade? And that's yet to come. Danny?
Yeah, you saw a 32% increase on the first 2 days and then 44% decline right thereafter. And, you know, you can go back and look now. There's probably a blackout period here, but you don't have any insider activity. Nobody's trading, selling, stock. You're seeing more buys than sells. But, I think that's the biggest thing is that a lot of times people get emotional, especially around this stock. I mean, if you really like, a lot of people like Trump still. I know a lot of people out there think that nobody likes him, but, we talk to all different types of folks, and there's probably a lot more that are quiet about it than that are loud. But this is one of those deals where you got to take the emotion out of it.
Right.
And that's what I think is still difficult for most is that, hey, I think this is going to go to the moon. And then you see that first day or two and you're like, oh man, I'm missing out.
Yeah.
We got to get in now. And then all of a sudden, the bottom falls out. And, Rich and I talked about this years ago. In fact, we were working at different places and we were talking about IPOs, and he advised me, he said, create a pros and a cons list of why you want to buy something, at an IPO.
Right.
And then, what your expectations are, where you think its price target is, and then come back to it in 6 months.
Yep. Again, you can say, well, look, if I would have bought Apple at the IPO, right, or Amazon at the IPO, look how well I would have done. Well, you forget. See, it's easy to say that because we forget that Apple lost about 80% of its value following its IPO. Amazon lost about 90% of its value following its IPO, right?
What would most people have done at that point?
Right. They would have sold it.
Yeah.
Yeah. So
I can't do this.
Yeah, and that's the whole. That happens with almost every IPO. And then, but when we look back over a long record, well, if I would have just bought Microsoft at its original, at its IPO price, look how well. And see, and the problem is we see these stupid articles written by MarketWatch in particular, all the time. It's like if you would have invested $1,000 into Microsoft when it IPO'd, you'd have $4 million today or whatever it is. Nobody does that, right? Microsoft's a great example. At the time that Microsoft was coming public, there was about 10,000, and that's a little bit of exaggeration, but there were just hundreds and hundreds of software-based companies just like Microsoft. There was CompuData and a whole variety of other ones. Most of them didn't make it. Microsoft made it. How would you know which one to buy? Yeah, hindsight's 2020. It's great. I can look back and say, man, Microsoft's awesome. It's just the best company ever, or whatever, right? But you didn't know that at the time. And this is always the problem, and especially when we get in the heat of the moment, like 2020, where we're bringing disruptor stocks public as an example. There's always a huge rash of them at once because Wall Street's finding every stock they can find to bring it public. There was a really good article out this morning talking about AI. There's a lot of private equity companies that are sitting on a bunch of cash right now that are not investing in AI. And you're like, well, boy, they're really missing out. Well, the reasoning is that they said that a lot of these companies are coming public or are getting a lot of traction. They don't have a business model. They're coming out with AI, but they have no business model. And so what they're waiting for is they're waiting for a company that comes to fruition that is actually getting a foothold in a structural business model that is sustainable, right? And that's where those private equity companies will invest. But whenever there's a rush of anything, right, everybody starts buying everything they can. And again, here's a good example of this. In 1999, you could not, the rush to get a .com internet address was overwhelming. Everybody was just coming up with any name in the book. People were just going online and registering names left and right. Anything with the .com address, then they would just sell the name later. There's been a massive surge in the last 12 months in a .ai address. So we have everybody rushing out now to get a .ai address. They don't even have a business that's in artificial intelligence, but they're going to get a .ai address just in case, right? So it's just that kind of mentality that we have going on. It's that same type of rush to market, et cetera. So again, you're not missing anything. If AI is going to be the next big thing, if it's going to be the next internet, if it's going to be the next fax machine, whatever it is, you've got plenty of time. And we'll see companies that come to fruition. We'll see startups that come to market that have viable business plans that earn revenue, have the ability to grow sales, et cetera. You've got plenty of time. You're not missing anything. But this is the lessons from investing is that when you rush to invest in something, generally you're going to make mistakes, especially early in the game.
Well, I think you just mentioned the speculation around that. I mean, if you're investing in companies that don't even have a business plan. So think about that. They don't know what their scalability is.
Right.
They don't know where their end user is. They just have a product that they think is good and say, well, we got to get there as quick as we can because everything is going nuts.
Right.
And that's it.
Yeah. I mean, think about just the shutdown, right? We had Peloton come to market. We've had exercise bikes for like 900 years, right? And everybody had to rush out and buy a Peloton bike, right? So it's just that type of thing. It's like whenever there's an event, right? We've got to get the next new thing. Just, there are some things that you can analyze and say, when you look at the valuation of a company, you say, okay, well, how many people have to, good examples of Peloton bike. I'm not picking on Peloton. I don't own a Peloton bike, but I know people who do. They make great coat racks. But
expensive coat racks, but very nice.
Very nice coat racks. But, you can just look at it and say, okay, well, how many people in the world would have to buy a Peloton bike to make this company equate to their current market value? And when that answer is more than the number of people living on the planet, there's your problem, right? So anyway, I exaggerated a little bit, but you get the point. All right, get ready to wrap up the show today. All right, sit tight, buckle up. Inflation data, 30 minutes away. So we'll see what moves the market. It's either going to be a heck of a big up day or a heck of a big down day. Probably not a whole lot in the middle. We'll see tomorrow. We'll talk about it with Michael Leibowitz in the morning. So be sure and join us in the morning for that. In the meantime, get by the website. Get our latest, Michael Leibowitz's latest article is out right now talking about gold. It's on the website now at realinvestmentadvice.com. Make sure and like and subscribe to our channel as well. We certainly appreciate the help and support, and we'll see you back here tomorrow.